Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today I'm joined by Veronica Morgan to talk about what's actually happening in the property market after the budget. There's been a fair bit of noise around policy, interest rates, investor confidence, and whether buyers are starting to pull back. Sydney in particular has been pretty lackluster, but suddenly feeling even a little bit more cautious, and that raises the obvious question: is this a genuine change in direction or just a pause while everyone works out what the rules are? We talk through what Veronica is seeing with buyers and sellers, where the market still has some depth and where things are starting to feel a little thinner. We also get into the gap between what people feel about the market and what the underlying numbers might still be telling us. For investors, this is the sort of market where you probably don't want to be swept along by headlines. You want to understand the detail. Let's get into it. Veronica Morgan, thanks for joining me back on Geared for Growth.
Oh, it's nice to be here, Mike. Good to see you.
I normally call you TV's Veronica Morgan. I missed that this one, but you've been doing more podcasts than TV lately, and I suppose we are at the time of recording early June, just before the end of the financial year. Probably too soon to see much data. We've seen a little bit of GDP. We've seen the Australian construction industry forecast saying, ooh, we're in for some pain. But what have you observed since budget, and what sort of conversations have you been having that have sort of changed your view on what's likely to happen for property?
I've had a lot of conversations and I've seen a lot of things. Now, in Sydney, so I'm based in Sydney, I've got a visibility across the country, but I'm obviously intimately familiar with the Sydney property market. We were already facing some significant headwinds and a real turnaround in confidence and in performance. It really, the official figures from December, but certainly we felt it in February. We felt it from the first interest rate rise. And before that, we watch auction clearance rates. That's a big metric in Sydney. And what typically happens in February, because you come out off the back of Christmas holidays and no new stock hitting the market, and people come back to the market invigorated after a holiday. And so February is often the peak of auction clearance rates for the year, which means that they're usually riding in excess of 70%. And that's how this year started, the same as pretty much every single year. And they normally will go all that way through February. And if it's going to be a big year, it'll continue. And if it's not, it'll peter out in March and then go back to normal. And so it's petered out in March and gone back to normal the last 2 years. And normal means clearance rates in the 60s. And so we call that a balanced market. So we went from a seller's market beginning of February to a balanced market after the first interest rate rise. And then in March, we had another interest rate rise and we went from a balanced market to a buyer's market. So clearance rates then dipped below 60%, been sitting in the 50s pretty much ever since. So we get to May and we already know the confidence is down, clearance rates are down. The official figures are saying that Sydney property prices in anything other than the bottom quartile are falling. And then you have the budget. And even though Sydney's not a big investor market, right? There's investors in Sydney, but typically it's not the market that the investors go for because it's not affordable, quite frankly. Yeah. But it doesn't really matter because it's the general sentiment, the general consumer confidence has infected, if you want, the whole market. So we're really seeing that there's just a lot of reticence for buyers to act, to commit. But you're also seeing a reticence of owners to meet the market. So another metric that we track is the withdrawn rate. So that's the percentage of properties that are withdrawn from auction that were previously offered for sale by auction. And that's gone up to, it's been on average for the last, I think, 8 weeks, sitting around tiny sliver under 20%, whereas in a normal year we would see that bumping around 10%. So it's twice as many people effectively have been withdrawing their property, and that's not unusual in a transitional market because people enter into a sale campaign with a certain expectation on price, and then the market doesn't deliver that price. They then say, look, I'm not going to bother taking the property market. I'll either take it off or I'll put it on at a price, and then it'll sit there, and then days on market start stretching out because those properties don't necessarily sell. So we've seen all of that. And what I see coming up is that people will stop listing their properties. What typically happens when the market sort of contracts like this, in Sydney anyway, which is a very established market, is that people, typically owners who are discretionary sellers, just won't sell. They will just choose not to. It's not the most advantageous time to sell my property, so I won't sell. So there'll be a certain amount of transactions that happen, but it will become more difficult to buy because it becomes more difficult to find property. So that, I just see the whole thing sort of slowing down considerably until something changes. I don't quite know what that will be or when that will be.
It's interesting, isn't it? Because there's sentiment and then there's fundamentals. And I think if we're looking at sentiment, it is detached from fundamentals, right? Like, if we look at the fundamentals of real estate in Australia, we aren't building enough, and you would argue we sort of can't structurally until a lot of things change. We are minimising international migration, but it's still reasonable. So the long-term fundamentals for an asset that is not discretionary, for example, everyone really requires a roof over their head, you would kind of think, okay, well, maybe we see some softening or some declines, but it does feel like everyone is sitting on the sidelines, especially investors.
And of course, investors are going to be sitting on the sideline now. Right now, we're discussing this, and the budget has been announced, but there hasn't been legislated, and so we don't really know what's going to be put in place. And then there's all this talk about the rise of one nation, and who knows what's going to happen there. Who knows whether we'll have a change of government next time an election comes around, and will they repeal whatever changes are made anyway? So I guess there's a lot of uncertainty around there. Uncertainty is never a great environment for investing in anything, but certainly not in property, where obviously leverage is very high. And if you don't need to leverage in property, then the negative gearing debate doesn't matter to you. The capital growth debate will matter to you, obviously. So, generally speaking, investors, it's not an exciting time to be considering investing in property, unless you're a contrarian, of course.
Yes, and I do actually believe that there's lots of opportunities out there, perhaps not as many as maybe these investment-focused buyers agents are talking about, but of course there's a little bit of vested interest there, right?
Well, I mean, look, that's the other conversations that we're having is, well, what's the industry doing about this and all these crazy pivots that we're seeing? And, this suddenly, the next strategy, it's all strategies. Everyone's coming up with their latest strategy to fit within the tax regime, and the fact that people can't borrow as much money, or what structures they need to borrow that money in, or whatever's coming out. What worries me about all of that is that it's patently self-interested. It's got nothing to do with good strategy. It's got nothing to do with thinking about individual wealth creation strategies. It is really about making sure that I can get the most amount of buyers through my doors and charge the most amount of money to help them offload themselves into property. That does alarm me, and I think I've got lots to say about the budget as it relates to property. I think the very fact that they didn't even allow one property for negative gearing, or cap it, or at least give some people the opportunity to buy their first, or even rent investors, so those first home buyers, particularly in Sydney, who really needed the opportunity to rent vest. That door's been shut on them. And not only that, but a lot of first home buyers will buy and they plan to live in it for a year because they want to get all the benefit, the first home buyer grants and all the rest of it. Well, they plan to live in it for as long as they can, get to a point where they've got an LVR that's over maybe 12% or 20% or whatever. But, there's a lot of those first home buyers that do plan ultimately to move out of that property so that they can rent it out and ease their cash flow. That's gone too. If they buy a property after, the budget, then they won't be able to negatively gear even if they move out of it. So it will stuff up the strategy for, there's that word again, but it will stuff up the plan, shall we say, for a lot of first home buyers. I think I've gone off piece there, but in terms of my concerns, but I think that has not been modelled out. That has not been understood by the government.
Well, you raise a reasonable point there. It does sort of seem like the gantry ladder has been taken away and the baby boomers are sailing off into the sunset in the best tax settings of any generation Australia's likely to ever have, right?
Well, talk about, not wanting to even things up and not wanting to, exacerbate this generational divide, if you like. They've just made it wider because if I'm a baby boomer or a Gen Xer and I've got positive cash flow from my investment properties, well, I can continue to negatively gear. but a first home buyer can't. I mean, that's outrageous.
Yeah, and you wonder about the unintended consequences of things like this. For example, if you are a multi-portfolio property owner with a positive portfolio, do you start renovating them to pull them into a negative position due to tax deductions just to take
Yes.
advantage of it? There's all sorts of things that I think the government hasn't really
Mm.
explored, and you only got to sort of look to One Nation's official policy, which is scrap CGT changes and cap it to 2 negatively geared investment properties, and that goes some way to alleviating that issue that you raised. And it does sort of make you wonder, when we start looking at One Nation for sensible policies, what's going on in Australia?
That actually scared the pants off me, to be quite frank. But yeah, right, there's been a couple of things that they've come out with recently that I thought, actually, that's not too bad. And I cannot believe I hear myself saying that. And I've never been one to, I mean, I don't shy away from political debate, but I'm not one of these rabid, I don't sit on either side of the political divide. I have always been a swinging voter, and I always will be a swinging voter. But I've never really bought into this rhetoric around Labor being bad money managers. But I actually have changed. I've had a complete about face on that as a result of this budget. I think to come out swinging like this, so ill-considered, and I get that they've got to keep it under wraps until they announce it, but the lack of consultation, not just with the property industry, across the board, has been astounding, given the breadth of change that they're proposing. It's just a joke.
Well, let's go back and see if we can adopt the Labor mindset. They do have a problem with, I think, young people, depends on how you define that, but being a larger voter base than, say, baby boomers for the first time ever. So they are jumping up and down saying it's too expensive to buy or afford a property. And it's hard to argue with the income to asset price metrics. Of course, you can pay out on millennials for having the latest iPhones or avocado on toast or whatever, but that fact remains. They did have a problem with that. What have they done? They've brought forward that 5% deposit, which made prices go up, which is, like, that's a whole nother podcast, perhaps. But what they're trying to do is increase that first home buyer ownership rate. But I'm wondering, like, Could this ever have been a reasonable policy, given that people going in with maybe 95% LVR to an asset that is now far less attractive because of tax settings? Could it be that we are on the cusp of, we always talked about this interest rate cliff, but this could be a negative equity cliff for hundreds of thousands of first home buyers?
Well, particularly if they're encouraged to go and buy brand new, because we all know that the evidence around brand new property losing money on resale has been a much, much greater percentage, particularly if it's off the plan apartment, than it is for established property. So, by encouraging first home buyers to get into that space, then that's extraordinarily dangerous on a 5% deposit. One of the things that I do is, my partnership with Megan Wells and Home Buyer Academy, we've got the first home buyer course, and we're constantly encouraging first home buyers to think about their first rung on the property ladder has to be as secure as possible, and going and buying a one bedroom apartment off the plan is not. And it's going to be even more of a problem now, because they will be competing for these very properties with investors who will be piling into that space. That's going to encourage developers to put the price up if they can. Let's face it, I would if I was a developer. And so you're going to be paying even more for properties that have even less of a secondary market, because no investor is going to be able to buy it second time. They won't get any negative gearing. And certainly no first home buyer is going to want it, because they don't get any of the stamp duty concessions either offered by the state government. So it's a real trap for first home buyers. It's an opportunity for first home buyers currently in the established market, because all of a sudden they're in a competition-free zone. They're only competing with other first home buyers and maybe the odd downsizer. So that is actually a win for first home buyers currently if they're competing in that established space. So I think that's great. But I think you could have achieved something very close to that by limiting negative gearing in particular. The capital gains tax discount I've said, even I was saying this back when Bill Shorten lost the unlosable election, that really that should be looked at, and that really wasn't looked at back then. They were only talking about negative gearing, and I've always thought that the discount at 50% was generous compared to what inflation has been versus what it was when it was first brought in, and so I always thought that should be looked at. The way in which they've looked at it has just been outrageous. I mean, what they've not understood about young people is a lot of entrepreneurial spirit with young people and people who are wanting to save up their deposits even if they're using ETFs and shares or crypto or anything like that, but also people that are setting up side hustles and setting up their own businesses. I mean, there's an absolute disincentive for taking risks there and trying to create something that will add to the GDP, add to productivity, and really contribute to the economy. And I think that they've failed to understand that. I saw Katie Gallagher our finance minister being interviewed by Sarah Ferguson on 7:30 Report, and Sarah just seemed incredulous when Katie was saying, "Oh, we're now going to consult with that sector." Well, you didn't do that before. No. Now we're going to consult. It's like, it's no surprise there's been a backlash, and from young people as well, because I think they're not stupid. They've realised that this actually locks them out in many ways of advantages that have been given to the older generation. So I think the whole thing is a bit of a joke. So even thinking with the Labor hat on about trying to level the playing field and give opportunities, it seems to be that they really just want to make sure that somebody who's getting a pay packet every week doesn't feel like they're missing out against somebody else that takes risks. That's how it feels to me.
Yeah, and that's where people talk about the tax on aspiration, which again is maybe another show. But if we think about, by the RBA's own analysis, around about 70% of household wealth sits in a property, and many first home buyers hope to get into that property in a CGT-free environment for that asset to grow. For the next little while, what sort of growth do you think people can expect to have?
Well, this is interesting, isn't it? Because the government's modelling on all of this was that it wasn't really going to have a material impact on property prices. Well, I'm like, okay, we've already seen that it's had an almost immediate impact in Sydney and Melbourne, which were already under pressure. And it's also slowed growth significantly in those cities that have been going off, which is basically Brisbane, Perth and Adelaide. So the growth there has slowed down. Now, yes, I'm sure there's other reasons, interest rate rises, and there's war around, there's other reasons you could put to that, but I would definitely think that the budget is not helping when you've got headwinds. So I'm not sure the government's enthusiastic modelling around having an immaterial impact on property prices. It's not going to cause falls, but it will just slow down growth. I'm not sure that's going to be I'm not sure that will play out the same way. The thing too is, of course, that those figures are aggregated across the whole country. As we all know, there's thousands, possibly at least hundreds of markets across the country. So it's quite ridiculous to say things like there's going to be moderate growth, no price falls. Also ridiculous to say that they modelled it out and it's only going to be $2 a week extra rent that people have to pay. Mm-hmm. You know what I mean? Again, in what market? Because there's a huge amount of variability given whether you're regional, whether you're capital city, and whether you're in a unit dense area versus one that isn't. There's just so many variables that have not been considered in these sort of blanket statements. So I think, in terms of opportunities for first home buyers. And look, there's also various figures that are saying things like the Melbourne apartment market, for argument's sake, has done nothing in the last 10 years. In fact, a lot of people that bought 10 years ago sitting on properties that are worth less than they paid for it, and they call that a success. Yeah. And I'm like, okay, success for who? Success for affordability, but from a first home buyer's perspective, why would I want to buy into a property that I'm almost guaranteed is going to be worth the same in 10 years? As it is now or less? Why would I want to tie my money up and lock myself into that when I have no flexibility? If I decide to get married and have kids, or maybe have kids and not get married, whatever. But if I decide to have children, I'll need more space. And what am I going to do then? If I decide I want to move interstate, what am I going to do then? I don't have that flexibility when I lock myself into one property. So there's a real lack of understanding, I think, of really what goes into making good property decisions that really irritates me, I guess, whenever I hear these politicians and their policies.
Yes. And my next question was going to be about the Treasury modelling. I think they said that prices, let's just say prices are growing, they will grow by 2% less. If they're falling, I guess they fall by 2% more. They're also saying $2 a week extra on the median rent. Treasury obviously have discovered the number 2. Do you think they're aware that there are other numbers available as well?
It's a shame they didn't say that you could have 2 properties you could negatively gear. No, they clearly don't. They do know that there's other numbers. 0 is one of them.
It's 2 years to the next election as well, which may be of more interest to people listening to this show than anything else. That $2 a week rental thing as well, because that I think is probably one of the most problematic things about this policy, because as you say, if you are a first home buyer and you have whatever deposit or means or serviceability, because it's not just, the fact that you've got a lesser deposit hurdle, you actually have to be able to service that loan. If you've got the money to go now, great. Like, less competitive market, less investors, maybe some downgraders. There's even some nervous first home buyers, and why wouldn't you be? So there's opportunity there. But if you don't have that ability to go now or in the next 6 months and you are renting, if there's investors sitting on the sidelines, so that pool of investment buyers, that conveyor belt coming is going to stop. We've also got the government breaking an election promise and removing certainty, which we know is a big factor in investor decisions, like through the Pippa Investment Survey. It just kind of speaks to there being a big margin, or a rather large decrease in investment properties, or let's just say rental properties, which I think sort of people forget are part of affordability and they're part of supply. $2 a week, I mean, how bad do you think it could actually get?
Well, I think in certain areas, certainly in established areas where there's not the ability to add a lot of stock to it, you're going to see pressure of rents. There's absolutely no doubt. It will take a while for that to sort of filter through, though. I mean, you're the numbers guy. So you've got situations on each of the eastern seaboard states, so Queensland, New South Wales, Victoria. All of those have in recent years put in legislation around the frequency with which the rent can be put up on a property. So that's an unnatural force in a way in the market that's going to slow it all down. And so that means that in each state, really, you can only put up the rent once a year. And so, and that's I'm not saying that's a bad thing, but what that means is that it's going to take a while to see how this filters into increased rents. But what actually happens when a property is sold by an investor? Now, if you are an investor and you currently utilize negative gearing, well, you're probably not going to be in a hurry to sell that property if you've got a good asset and you can afford to keep it, right? So you're going to keep that. But they're not necessarily the investors that have been selling. A lot of the investors that have been selling have been people that, potentially going into retirement. There's a lot of people selling the bigger properties that they've actually owned for a long time. So they're not necessarily relying on negative gearing anymore. They've been positive cash flow for years. And there's been a lot of changes to property taxes, for example, in Victoria. That's put pressure on locals. And so they said, this is just a joke. I am not seeing my properties go up in value, and yet I'm seeing my land tax bill go up and the actual cost of holding it. I'm not seeing the value in keeping it anymore. So there's been reasons why investors have been leaving the markets, and some states more than others. But what actually happens every time an investor sells a property, and I guess what we will see is getting closer to that point where the negative gearing, the capital gains tax discount will change from the 50% to the index model, then there will be investors that are cashed up, or that would like to be cashed up, might then decide, okay, well, I'm just going to maximize the gain and sell the property now. So every time an investor sells, it doesn't necessarily, it's not like one for one. The average number of people in an investment property, so per dwelling, is higher than the average number of people per owner-occupier dwelling. So I don't know the exact numbers off the top of my head here, but say it's 4 people per investment and there's 3.2 or something for owner-occupiers. That's 0.8 of a person each time a property changes hands from an investor to an owner-occupier. And this is the simple mathematics of it. And often what you'll see too is that you're not going to be seeing people reinvesting in established markets. So you are going to see a lot of pressure in established markets because each time an investment property sells, it's not going to be sold to an investor. And gradually that stock level will deplete. And that is only going to result in increased rents because you'll have less supply. And the people that can afford to continue to live in those areas will pay higher rents, and those that can't will get pushed out to other areas.
Yeah, and I think one thing about Australia that is different to the US, for example, that we're quite proud of is the gap between the rich and the poor is not as ridiculously wide, but it kind of feels like we're heading down that model.
Well, and this is the injustice that actually is embedded in this. It's baked in. I'm mentioning earlier about the baby boomers and Gen Xers that who have already made money in property can continue to do so with the same tax arrangements, forgetting the capital gains tax discount, of course, but can continue to utilise negative gearing to borrow, to get, to afford to borrow more to buy into residential property. They can continue to do that. And that's the only group that can. Those who already have.
Well, I mean, there's a lot that we could talk about here, but let's try and zero in on some practical advice for people that are first home buyers, for people that were planning to invest in property, for people that were looking to upgrade their PPOR. What advice would you have for those cohorts right now?
Well, I think the upgrading your principal place of residence, the market, assuming you're buying in the same sort of market, buying and selling in the same sort of market, geographical market I'm talking about, you're in the box seat in a falling market. If the prices are falling, and let me just be very clear here, prices do not form by a uniform amount, despite what the headlines seem to suggest.
But core logic here says that the national market has gone up by X percent.
That's it. Every single house in the nation has gone up by that percent or gone down by that percent. It doesn't actually work that way. But as a general principle, if you're selling a less expensive property to upgrade to a more expensive property, the gap between the two, so to bridge, is smaller or shrinking in a falling market as opposed to growing and getting bigger in a rising market. So the market conditions are actually very, very good for people who are upgrading at the moment. So I encourage them to take advantage of that. The challenge with that is always finding the right property. Because as I mentioned earlier, a lot of discretionary vendors will not be selling. And the other challenge with that is getting your own head around accepting less for the property you're selling than you would have potentially got for it a year earlier. Now, we do a lot of vendor advocacy work. We do this work across the country, and it's one of the challenges we know every single owner faces in any market is that most people who own a property really think it's worth more than probably the market really wants to pay. Now, in a rising market, you can get competition, and there's ways that potentially you might get your expectations exceeded or at least met. But in a slow market or a falling market, that's more challenging, right? So those conversations that we have with owners before they decide to put their property on the market is really quite challenging. Sales agents can't have that conversation with you because they're trying to win your business. As a vendor's advocate, we can have that conversation with you because we're trying to protect you from starting a campaign that's doomed to fail. But it is a challenge for people to accept that they're not going, there's a vanity metric, if you like, for the property, particularly if it's a home, that I want to get a certain price for it. And it's really hard to get them to take their focus on what they perceive to be losing, to put that on what they could be gaining in terms of a smaller changeover cost. Yep. So that's an interesting, just a behavioural bias there that kicks in all the time. But absolutely, that is something I would encourage people to be doing. The other thing too, there's more and more off-market deals, and I'm not one of these buyers agents that bangs on about, I get all these 80%
Veronica
off-market
Morgan
deals.
Buys 99% of her properties off-market.
I know, the secret market, the hidden market that only I've got access to. I cringe whenever I hear anybody talk about that. Look, there are off markets, and we do buy off markets, but it's nowhere near as prolific, I guess, as some buyers agents claim. Now, having said that, we do buy more off market in a slow market because Owners are not wanting to expose their property to the market. Agents will often know who will sell for the right price. We've got to be very careful because a lot of them really want a premium to be leveraged out of their homes. But there can be opportunities there. So working with a buyer's agent that does have extreme local knowledge and very good relationships, long-term relationships with those agents, can be fruitful in helping you find those sorts of properties. And then you can have more confidence around selling. You can buy with longer settlements. There's a lot more flexibility that you can, you can, in terms of the terms of your offer, and in a slower market than there is in a competitive market. So there are opportunities there for upgraders. As I mentioned earlier, first home buyers buying in established markets who previously would have been competing with investors are in the box seat right at the minute. And everybody else just has to work out, what their motivation is. Like, why am I selling? Why am I buying? And can it wait, right? And for some people, it shouldn't wait. And, you need to be approaching it just thinking about where you are in your life, rather than trying to game the market or trying to time the market. And then when it comes to investors, this is an interesting one, because I encourage you to talk to your accountant and obviously your mortgage broker in terms of affordability and what you can borrow, how the lack of negative gearing will impact your borrowing capacity, et cetera, et cetera. But if you're not relying on negative gearing, you still get those deductions, you just get them later. And I think having a conversation with your accountant about really what does that look like, and does it still make sense for you, particularly as you can be opportunistic in their market. I think for someone who's a bit calm about this, they can do very, very well. And so it's about understanding your own circumstances, but try to go against what the herd's going to be doing, because they're all going to be rushing to buy brand new.
Yeah. I'm glad to get that answer to those questions, and it was a big one. If we're looking at the,
I've been giving this a lot of thought.
No, I've no doubt. But if we and let me sort of see if I can parrot it back to you in a succinct way. For an upgrader, let's just say the market is 10% cheaper than it was, and you've got $1 million house you're selling for 900. You've lost 100 grand. But if you're buying a $1.5 million place, you're now buying it for 1350. So you've bought it for 150 grand cheaper. So you're actually in a positive state. And of course, if the gap between selling and buying is reasonable, every day in a declining market, you are sort of ostensibly making more money. So that makes sense. For downgraders, could be worth reassessing your time. For first home buyers, it's probably less about, well, what's the market going to do over the next year, 5, 20 years? It's probably more about, can you afford this thing? Right? Can you afford the fact that you might go into negative equity? Interest rates might go up. But at the end of the day, as we mentioned in the beginning, property is not going to suddenly be worth half what it was pre-budget and stay that way forever, right? We can't build enough. We have quite a lot of demand. And then when it comes to investors, there will be some opportunities. If there's a lot less investors, then we will see rents rise, and then we see a yield differential that makes investing more attractive, and investors come back in. So in a way, even though we've got Labor running some rather communist policies, there is kind of like some free market balancing that will happen. So is anyone in their right mind sort of, could you forgive them for sort of saying, I'm not doing anything, I'm not doing property anymore?
Oh, look, always forgive people for saying that. But it's interesting. I've been in the business now 26 years, and every single time we have, these sorts of constrained circumstances come around, we've had a number of cycles of this, and every single time people sit on their hands and they all decide to get off the fence together. And then that's what makes markets move. So I think Domain and CoreLogic both came out with charts back in 2022, I think it was, when Sydney went into decline the last time. And, both of them showed, one went back 30 years and the other one went back 40 years. And both of them showed that over that length of time, the market, I think they were actually for national figures, the market in total spent a third of the time, or 3 times longer in upturn than it did in a downturn. So that's a quarter of the time in a downturn, 3/4 of the time in upturn. And the gains in upturns were 3 times magnitude of the decreases in a downturn. So when you smooth that all out over decades, that shows growth. There's going to be ups and downs, but there's less time spent in the downs. Now, that's aggregated data for an entire market. We know that individual property choices can cost terribly, gravely, because some people do lose money on property and they don't recover it because of the type of asset they bought. Other people do choose great assets that actually do better than the market. So there's opportunities within that to make good decisions and bad decisions. But as a whole, the market, generally speaking, spends 3 times longer in positive territory than it does in negative territory. And I think that's pays to think about that when you're buying, because you're not going to be able to time it perfectly. Even experts can't work out exactly the trough and the peak of the market. So we always know it in hindsight. So
Yes.
we've got to sit down and just work through what our life plans are, what our goals are, and does buying now fit with that or not? But instead of trying to ride the wave.
I think that's really good advice. And I've just glanced down, and this is admittedly very out of date, but I'm looking at, I think it was the end of March CoreLogic figures, and the combined national annual change in dwelling values was at 9.9%. Now, like, that's not the best it's ever been, but that we've never actually had a downturn that big, right? So that kind of puts it into perspective. Like, if that was the decline over the last 12 months, that would be incredible national
Yes.
news. But that particular increase, it's sort of like, oh yeah, property's doing its thing.
Yeah, look, and it's interesting too, because, you look at, well, we're recording this early June, and obviously Cotality brings out their figures on the first of the month, and you still got some of our cities in growth mode, albeit slower. Definitely the pace of growth has slowed down, but they're still in growth mode. So it's very rarely, it's only in 2021 when the whole country was in positive. We don't see that very often.
No.
There's swings and roundabouts happening all the time. So it's just, we'd spend a lot of time talking about this data. I'm not sure it's that useful, to be honest, when you're making individual decisions, because you're buying one of how many million, there's 11 million properties out there. We go to buy one, we're selling one of them. We go to, or buying one of them, when we go to sell, we go and sell one of them. We're not selling or buying individually in a way that's tipping the scales in any way. And we've got to make our individual property decisions. And yet, we always talk about it because it fascinates us, but it's not really useful for people.
Yeah. So if we can summarize this chat, it kind of, like, if we were to turn it into an object, it would be one of those Churchillian sort of keep calm and still do what you were going to do mugs, right?
That's it. Keep calm and carry on, unless you're downsizing or you're investing. I certainly, what's getting me, I'm actually shocked. Well, maybe I'm not shocked, actually. I'm disappointed. That's probably a better word, at the amount of property, and I'll put rabbit ears around this, advisors and experts who have been pivoting their strategy, their investment strategies for people, and pitching, ways for investors to continue to buy when we don't know exactly what's going to be legislated. It's not, and I really do think for investors, unless those changes make no material difference to you, then just wait. Right? Don't be knee-jerking and changing your strategy. I'll be waiting and seeing what is legislated. If, however, none of that matters to you, go and take advantage of some market opportunities. Be really choosy and, see what you can pick up.
And if you've ever been one of those people that said, gosh, I should have bought, or I wish I'd bought when, and you could insert, lots of different things, GFC, COVID, interest rate hikes, strikes on Iran, any of that sort of stuff, you might be worth tapping yourself on the shoulder to go, is this one of those particular times? Do you believe it is?
I do believe it is. I mean, this is the thing. It's just, as I said, I've been around 26 years. Every time we see these sorts of stuff going on, you go, oh, here we go. I've given up trying to convince people. I'm like, they've just decided to do what they do. But I've in previous years, I've gone back and I've gone through all the data. I've looked at my own blogs and my own research and go, here we go again, here we go again, here we go again. So yes, I do think here we go again.
Well, Veronica, thank you for bringing some calm and patient advice based on your 26 years of real estate observation. Interesting to get some insights on what's happening on the ground in Sydney as well, because that was a market that hasn't been sort of the heavy lifter for national house prices. So For anyone listening at home, what's the last bit of advice you want to leave with them?
Oh, it is not to get swayed by headlines, not to get swayed by something you see on TikTok. It's just to be very careful about your property decisions, because they are, anything you decide to do now does have long-term implications. It's the motto in our business. It's really, we're here to empower decisions today that benefit future you, because a lot of people are making short-term decisions with property, but every property decision has a long tail. And that's the thing I would just please encourage people just to stop for a minute and recognize that these are important decisions that really will make or break you financially in the long term. So take your time and get it right.
I love it. Couldn't agree more. Thanks very much, Veronica. Appreciate you.
Thanks, Mike. Thank you.